Hello and welcome to Structured Finance in Focus, a Fitch Ratings podcast that takes an in-depth look at the latest developments across global structured finance markets. My name is Ben McCarthy. I'm a Managing Director at Fitch Ratings and head up the analytical team for Asia Pacific for structured finance and covered bonds. Today I'm joined by Natasha Vojvodic, who leads our structured finance team covering Australia and New Zealand. We're recording this podcast following a series of investor roundtables in Sydney, Melbourne and Auckland. We plan to cover some of the things we talked about at those meetings and the outlook for Australia and New Zealand structured finance for 2025. Natasha, welcome to the podcast.
Thank you, Ben.
Natasha, our last podcast in November last year covered the year 2024, which was characterised by a massive increase in issuance and the good credit performance across all asset classes. I don't want to go over that ground again, but I am interested in how 2025 has started and whether you think 2024 will be repeated. I've got three rapid-fire questions for you to start with. I guess the first one is, from an issuance point of view, how's 2025 started?
The year has started very strong in terms of issuance. It continued from a very strong end to 2024. And I think we haven't seen the number of transactions already out in the market so early in a new year before. It would be very interesting to see if this continues throughout the year.
Thanks, Natasha. And what are we expecting in terms of credit in 2025?
We changed our outlook on asset performance of all structured finance asset classes in Australia and New Zealand to neutral from deteriorating. This means we expect asset performance to stabilise or slightly improve. This is based mainly on interest rates coming down and unemployment remaining low.
And Natasha, my understanding of the change in outlook from deteriorating to neutral is predicated on interest rates falling this year. Is that accurate?
That's correct. So Fitch's expectation is that there will be approximately 3 cuts of interest rates this year. So our expectation is that that will lead to improved performance across all sectors. This is in the same way that increases in interest rates led to a deterioration that we saw over the last couple of years.
And in terms of property prices, that's a question we consistently get asked. What's our expectation for property prices in Australia?
Our expectation is that we would see similar growth to what we saw last year. So our forecast is for prices to go up in the range of 4 to 6%, even though property prices have decreased very moderately in the last couple of months. With those cuts in interest rates, we expect borrower capacity to improve, which would lead some increase in property prices.
Thanks for that. We spent a lot of time in the past few months talking to investors about the changing characteristics of Australian RMBS pools, particularly about low documentation loans and underwriting creep. Can you elaborate a bit on what we're seeing in RMBS pools?
Yeah, so in RMBS pools, we're seeing a lot more low documentation loans making up a significant portion of some portfolios. So these low documentation loans are provided to self-employed borrowers. So there are some portfolios that have 90+% of low documentation self-employed borrowers. The other thing that we're seeing is a reduction in servicing buffer used to assess borrower capacity across some lenders. So non-banks typically now are providing or assessing loans at 2%. For some of these, like what we're calling like-for-like refinancing, that buffer has reduced to 1 or 1.5%.
Thanks, Natasha. And the term underwriting creep, which Fitch has come into the language used at Fitch, can you describe what underwriting creep is and maybe give some examples of what we're seeing in the Australian market?
Yeah, so what we mean by that is across different lenders, there may be variations in how they're assessing these loans. So I spoke about this lower servicing buffer for some loans, but we're also seeing some of the methods and number of income verification methods changing over time as well. So if we look at a low doc self-employed borrower, for example, typically that used to be that the borrower would need to provide 2 forms of income verification. So that may be bank statements, business activity or BAS statements, which is an indication of revenue turnover for the business, as well as an accountant's letter. Currently, or across the lenders, that has now moved to one form of income verification method, and that method has typically been the accountant's letter. On the full doc self-employed borrower assessment, Again, we used to see 2 years worth of financial statements and income tax returns, and now that has moved to 1 year worth of financial statements and tax returns across some lenders.
Their understanding is changes. Some of it is sort of, speed of processing is driving it, and it's being driven by the sort of increased emphasis on broker originations. Current levels, people are talking about the broker originations being, 75 to 80% of all mortgages in Australia are now written by brokers. Is that accurate? It's an impact of brokers.
It is. I mean, brokers will write loan for most borrowers in the Australian market, and service is a big thing that we're always being told it drives where the business will go. So that is a telling reason, especially for the increase in low documentation loans.
And I guess that leads to the next question, which is just around this underwriting creep. We sort of heard the phrase that, all these little changes individually mightn't mean much, but they might add up to something. And what Fitch doing in its modeling for ratings of portfolios, and are we seeing changes in credit enhancement as a result?
Yes, we are. It is too early to tell whether any of these, either singly or together, will have an impact on future performance. But we are looking at some of these attributes and adjusting in our models. So for low documentation loans, we've always had an adjustment for a low documentation versus full documentation. So that will continue or has continued. The reduction in serviceability buffer that's used in what I was referring to previously in the like-for-like refinancing, we are adjusting those at the individual loan level. If the borrowers were assessed at the lower rate of the 1.5% and they were not able to pass at the 2%. If they were able to pass at the 2%, even though having been approved at the lower servicing buffer, then adjustment being made. And the amount of like-for-like refinancing that's in portfolios does vary across the market as well. And the other thing that we do is if a borrower has been self-employed for less than 2 years, regardless of what the underwriting criteria is for that issuer, we will assess those loans as being a non-conforming borrower and not a conforming borrower, even though it may be clean credit. So they're the things that we're doing. Just one thing I also wanted to point out, even though there's more loans being written by brokers, the underwriting assessment is still done by the lender. So there hasn't been any change in that. The broker is simply an introducer.
All right, thanks for that. And thanks, Natasha, for those insights. We might leave it there. Thank you to listeners who've joined us today. You've been listening to Fitch Ratings Structured Finance in Focus podcast. If you want to learn more about our ratings or research on structured finance, or to access our index reports or pre-sale reports, please visit us at fitchratings.com. Please subscribe to this podcast on iTunes, Spotify, or wherever you get your podcasts. Thanks for joining us.